about where do we place the extra dollar of investment? Where do we get more return on RWA or return on equity, right? So that really forces now banks to have a fundamental mind shift in the way that they actually plan. Now that's where stress testing suddenly becomes more interesting. So far it's always been I would say, a regulatory requirement, right? So you do it because the regulatory demands you to do it. And accordingly, the interest from the business side of the bank to get involved in that has traditionally been relatively muted. Now in an environment where we're at right now, where you're actually looking not so much at the extreme events, right? Nobody really plans for that. You want to be sure you survive one, as coming back to your presentation. But from a business perspective, in this new environment, you want to understand, or the business wants to understand, what is the impact on macroeconomic environment changes? What's the impact of our bank decisions, strategic decisions, on our next 3 years plan, on our budget, and therefore on our bonus? Right? For business leaders, this is much more interesting to hear what can make us miss our target in the next three years, rather than the 1 in 25 event that we hope we survive, but that's not my business plan. And so we see a lot of interest right now, a lot of questions that are related to getting a better sense for what is the variability of actually the base case. And far from going into stress testing, many banks are still at a point where actually their base case, their projections for the next 3 years, their business planning has a lot room for improvement in terms of now, and that's where I'm coming back to my point around liquidity and capital becoming less plentiful. For the first time, you really need to think through what are the implications of certain business decisions that I take. So do I grow this particular product versus another? Do I grow in Indonesia versus Thailand? Right? Do I grow in wholesale banking or in retail? That impacts both your liquidity position and your capital position, because they're all impacted differently by the new regulation, different requirements. And so we see a lot of the demand right now, or the question that are being raised now coming not anymore so much from CIOs, but more and more from CFOs and CEOs of the organizations. And that's a very important, very interesting shift in the mindset. And then stress testing is no longer just a regulatory tool, but actually a strategic tool that helps the CEO and the broader management to make more and better informed decisions around.
But are you seeing your clients actually building that capability within their institution to do this risk management and
yes,
within Asia?
Yes, also within Asia. Now, the interesting bit there is, I would say, in Europe, we see the inverse happening. They invested into stress testing quite heavily, and they're now asking how can we use this to make better predictions and better planning, because it determines basically our bonus, our payout ratio, dividend payout. I think Asia is an interesting situation where that question might come first, or that question, that question might actually determine the investments into improving these capabilities, if you know.
Makes sense. So in this regard, I do have a question for you, which is, let's say your footprint of risk management is fairly large. So there are different regulators from country to country and region to region. How do you deal with this diversified portfolio to manage risks?
I think country risk was much talked about, which is actually a very, very pertinent area of, if I could call it expertise, but I would think twice before saying we're experts in any country. Countries are very complex. Regulators, as we would know, deal into different layers or categories of institutions differently. The large local banks, a different mindset. We've seen that obviously globally across the US and UK and Europe. It's also in Asia. It depends on the size of the operation and the types of businesses you do in a particular country, which determines the type of interaction with the regulator. And secondly, it also depends on A, the mindset of the regulator, and B, their recent learnings from any recent incidents that expose certain vulnerabilities in any of the other institutions. So a lot of times the questions, the ICAPs or the stress testing, depending on which jurisdiction we're dealing into, are a function of the environment the regulator is dealing into and their plan to progressively move in the direction of greater robustness and what's their journey, how fast they want to go, or do they feel this is something they want to deal into at a future time. So it varies. I think the important piece of it is to listen to the regulators very, very closely, to appreciate their hot buttons and their nuances. I'm not for a moment saying trying to manage the regulator, because the regulators have gotten pretty smart. They walk into your office, they spend time, and they can read the air, and they like to talk to the business people. And to your specific question with this background, MJ, how do we deal into it when we've got so many countries and locations, and you, sir, would have a much better perspective. But ultimately, you need local, on-the-ground expertise. You need people, comes to capability, your point in the earlier session, where you've got to combine local capability with head office risk appetite and frameworks, and with home country regulatory expectations. So the bar is the higher of the two for every single point in context, and at the same time, it's sort of a balancing act. And I think communication between CROs for each of the countries is very important, because the regulators are talking to each other. And knowing what's happening in another country, which might be a little bit more advanced in a certain aspect, gives us the ability to anticipate the direction of where it might go with the other regulators. And this is sort of a trend, I think, particularly in Asia Pacific, that we do see, where there is, if I could call it, regulatory contagion, where each regulator takes cues from the other. I think the other aspect that regulators, in my personal experience, have paid attention to, and rightly so, is what is our own rhetoric internally about our own environment. So our own internal audits, our own internal reviews is something they pay attention to, and it just also throws the limelight from their perspective, and they want quicker remediation and correction in areas of weakness.
Thank you, Anju. A follow-up question to that. So how do your frontline business colleague look at you? If you are setting these boundary conditions, do they look at you as a colleague? Do they look at you as a regulator? Do they look at you as a foe or a friend?
Yeah, I think it comes down to, cliched as it may sound, relationships, and managing relationships is more important for risk officers than it has ever before been, because the partnership that we need from business is critical to the success of the organization. And a small subset of that is critical to the success of the risk function. It comes, and I think in some ways, the regulatory environment helps us, because the regulators, when they walk in the door, they actually first want to talk to the business people in so many countries. And I see situations where the business guys want to talk to me when a regulator is coming in the door because they want to prepare themselves. And for the first time, it starts out as preparing for a test or an exam. Then you realize that it's going to happen again and again and again, and it becomes part of a routine and gets embedded as a culture. I'm also an eternal optimist. So I think the environment as a whole has helped us as the risk team members to facilitate things in the right direction.
Thank you. Very helpful. There's a question from the audience, and Dr. Zhao, it's for you. So, everyone talks about hard landing of China in a stress test situation. You yourself are the CRO. So, how do you balance that information of hard landing in China? Yes, it's happening. Is it exaggerated or not? You're closer to the situation, but in your own stress testing scenario, how do you use that information?
Well, that's a pretty good question, firstly. I think it's reasonable to synthesize that the down play or the sort of economic in the way of downturn in China, or the slowdown simply, is a real worry almost everywhere in the world. And if you travel to the countries other than China, in every place like this, we can see the topic will be eventually relates to China's slowdown, and in many cases, even those symposium for security and defense issues would also classify China's slowdown as one of the top geopolitical risks. Why this happens? Now, firstly, the Chinese economy is slowing down. I think this is something that the Chinese government engineered on a new track for the economy to run down. And secondly, we also see many factors that are really important to the well-being or the health of the performance of the economy are not supportive anymore. And thirdly, my own thinking or my observation for the past few years of the macroeconomic decision process was actually some fairly bad mistakes committed within, the self-ruling hierarchy, and that happened simply because the assessment of the economic performance itself is so contradictory, and there was never ever that the opinions would run together, that the Chinese economy has been on the right track, or really too hot, or something like that. And therefore, in each year, there will be a very senior economic, what we call economic, symposium on economic work. In that particular symposium, the tone or the real track for the year to follow will actually be set. Now, that symposium, in most cases, are based on a sort of unsound or unjustifiable solutions in evaluating the state of the economy. But put that aside, I really think the economy is still in a managed state of good health. We can say we have the confidence because of three reasons. The first, this slowdown has been a readjustment that has long been underway, and therefore many indicators that you are so familiar have not been that sort of a proof anymore for your traditional judgment or those conventional evaluations of the state being has already been out of date. Now the second reason here is that the whole economy is replaced or being directed into a new orientation, whereas the consumption is taking a big shape. And therefore, the traditional drivers like investment, although it's still there, but now the rate has been in a much, much lower pace for quite some time now. And then foreign demand in terms of export has also been slowing. For many years, the decision was that we should expand the market size by way of diversification and also upgrading of the products that we made in China. Now all those efforts are really gearing into the right trajectory, but it takes time to make them really bear that fruit expected. The third thing here is that you see the traditional manufacturing and also those so-called Internet Plus are all taking shape. For the traditional manufacturing, I think the robot imply and also the computer-based management or production, and therefore the new modes of production is also taking shape on a gradual way, and that's also why we see many of the components of the economy that have been conventionally considered as drivers are not moving or not moving that fast as yet. Now, the domestic performance can take that sort of a dynamic as a natural or intuitive sort of a development. But the real danger here is that there might be synergy in between the bad and even worse economic performance and those foolish, groundless moves by the Fed, if that really happens, I think the Chinese economy can be easily taken to the water. Why this time the real crisis can happen in China? Because the Chinese decision-making process has been too much influenced by the speculative movement in the United States. And what we see for the last 7 years in the wake of the collapse of the Wall Street back in September 2008 is that the virtual economy represented by those three stock markets are hitting records all the time. On the other hand, the real economy in the United States has not that really good? No. The real economy in many cases will be contraction after another contraction. So the performance or the decisions made in the United States this time can have some serious implications on the state or the well-being of the Chinese economy.
So does that mean the question which talked about the hard landing of China, it is about the US actions may cause that? So in the scenario planning,
the synergy might be there. And the second thing is that on a macro scale, I think the top decision makers showed some impatience that we should internationalize our money, renminbi, as soon as possible, or at least we should have a timeline. See, the People's Bank set that guidelines already. In 2 years, the whole regulatory framework would be just open or targeted toward a very, very regulatory free framework. That can be very risky, I tell you. This is something that the Chinese economy cannot really accommodate. And if that really happens, I think the hard landing will come. But other than that, we have pretty much reasons to believe that the Chinese economy is still running in good faith. Thank you.
thank you, Dr. Jha. Very insightful answer.
May I just add to that? That's actually a very good point coming back to the modeling question before in the presentation. Those are the things that you cannot model. Right? These are step changes in an environment, in this case because a regulatory change, right? A currency is opened up and internationalized. That is not something that you can base on data analysis and build a statistical model on, right? So this is really a scenario that you paint, if you will, that you design, and then think through in a structured manner around what the implications might be, and design a stress testing around that. That's where your models might come in at that stage. But for this,
MJ will have a different view.
I believe.
But this is also see, something for me that has a lot of reservations about techniques like stress testing, because even you are a marvelous swimmer, but when the tsunami is coming, see, and therefore, to just looking into sort of risk models can be very risky also, because that will be leading to your attention in a sort of a institutionalized way, and that can obstruct, in the way of your real vision in terms of those macroeconomic environment, and also the bigger environment that are really paving the way for your business to grow or to disgrow.
Yeah, not to discourage the use of models. I mean, I'm the first one who earns money from building models, so don't get me wrong, right?
Dr. Zhao gave a very interesting insight into an age-old saying in India which says, trust in God but do lock your car. So
Right.
stress testing is important, but it cannot be the only way to manage risks. So on the statement that Wolfram you made about the modeling, actually that's precisely why stress testing is built, to truly create a scenario in which, for example, look at the RMB internationalizing, and if you were to look at all the ASEAN trade, inter-country trade, everyone's number one trade partner is China. Overnight, if China, the yuan was to internationalize, the trade between the countries can be done in yuan, not in US dollars. What it does is, it has a very different traverse or path to liquidity. The liquidity pools start shifting around, and that can be modeled, and it is very dangerous. So for financial institutions, very well said. That's a very interesting insight, Dr. Zhao. If not done properly, that can be quite disastrous to the economy. So one question that has come from for